Welcome to a video that I like to call the deep dive video, but I feel I need to explain the concept behind this video. Every week I do a number of videos. I do a video each day. I do a video each week. I do an intermarket analysis video once a week. Then after I'm done for the entire week, I go through all of the daily charts and I go back and I look through them and I pick out the charts that I didn't cover in any of the daily videos. Or maybe I just covered one or two times and it's changed, but not enough to be included in the daily video, but it might warrant being included in this video. There are also some additional charts, and I'll have some other charts that I usually don't show in this video, but there are charts that are exclusive just for this video. And this kind of ties everything together. We've done our analysis each day. We've taken a bigger picture look. We look at other markets. Now we kind of tie it all together with this particular video, but it's a little disjointed. It doesn't flow like the other videos that I do. This is being prepared for Monday, December 4th. The first chart is we look at the VIX, and this measures sentiment. When the VIX is high, it's time to buy. When the VIX is low, it's time to go. And when we get to an extreme reading, we tend to use this as a contrarian indicator. When it's drifting higher or drifting lower, we can go with that. But when we get to an extreme positive or negative reading, a lot of times we're looking for the market to shift. The problem is the VIX, when it was originally developed and how I used it for decades, was according to static numbers, 12 to the downside. When we're at 12 or below, that means there's no fear in the market. When we get to 20 or above, that means there's a lot of fear in the market. But the VIX is more dynamic than that, and it goes above these levels and even below these levels at different times. And so what I've done is I have a VIX on this chart, but I made it invisible. And then over top of that is a 50-period exponential moving average. And that's the blue line that you see. And this shows that different periods of time, the VIX tends to stay in a different range. We look all the way over to the right-hand side, and you can see that the VIX has really been dropping, and it may be getting ready to establish a new longer-term range. We don't make any decisions based on this. This is more for informational purposes. It's just a good thing to know when we're looking at the VIX every day. What is the bigger context of how the VIX has been behaving? Another chart that I was using earlier in the week is how fast is the VIX moving? And we use the RSI indicator based on 9 periods to help us determine that. Now, you have to kind of think backwards with this, because when the VIX is going down, that means stocks are going up. When the VIX is going up, that means stocks are going down. And we had become extreme negative as stocks were going up. Well, we've been able to work off of that. Now, if we have a really solid up day this coming week, we could bump down into this extreme negative territory again, but we were there, and I was including this in the videos, but since we're going back up, I have not been including that in the videos. We also look at a correlation. We still use the VIX to measure sentiment, but we correlate it with what's it actually doing when we compare it to the S&P 500. And that's the middle area that we see on this chart. When we're getting a really high reading, sometimes we're not seeing that in our other VIX studies or other fear gauges that we look at. Well, right now, this is giving us a really low reading. So this chart is not necessarily telling us something. When it spikes up, like it does sometimes, then we might get some insight from this chart that we're not getting from other charts, but it's not helping us right now. We also look at the MOVE index, and that measures the volatility of bonds. That's the top area of the chart. The VIX, of course, measures the volatility of stocks. And then we have the S&P 500, which is in red. And then I take the spread between the two. I take the VIX and I subtract the MOVE index. And this has been moving just a little bit higher, meaning that stocks, they've been a little bit more volatile, but when we look at a ratio, that other ratio chart is actually going down. What I pay most attention to is at the bottom, the correlation between the top chart and the middle chart. And they have a pretty strong tendency to go in the same direction at the same time. It may be going up, it may be going down. We just want to know, are they both moving more in tandem or in opposite directions? Right now, they're having a tendency to move in tandem. Then we look at the skew index, where the VIX looks at the money options, and that's how it's calculated. The skew index looks at out of the money options, and sometimes we can get some insight from that. Not too long ago, we spiked up into this red area, and that was meaning that, okay, the market was expecting some kind of a big move. The problem with this indicator is we don't know the direction. Now, a lot of people look at the SPX index, oh, it's getting really high, stocks are going to tank. Well, the last time we had this reading and then came back down, we ended up going higher with the S&P. There's other times when it does mark a top and we end up going down from there. Other times when it just is a continuation. The market just keeps going in the same direction as this index starts coming down. Then we want to keep an eye on how far are we from the all-time high. That was set in January of 2022. That's way over on the left. Way over on the right is Friday's close, and we're down 4.65% from the all-time high. We're getting kind of close, and we're potentially coming into some positive seasonality from pretty much the middle of December until the latter part of December. And you have to kind of speculate. Do you think we'll go back and test this all-time high? Will we be able to set a new all-time high at some point? We don't know that yet, but we kind of keep that in the back of our mind. Then stockcharts.com has this thing called technical alerts. And this is for pretty much the whole week. And if they're positive, they're blue or green. If they're red, they're negative. And this is not just for the S&P 500. This looks at other indexes. It looks at sectors. It even looks internationally to a degree. The very bottom, TSX, that's Canada. Well, we start from the bottom and read this chart up. November 28th, that was Monday in Monday's session. I believe that was Monday, or was that Tuesday? And then we read it all the way to the top where the last trigger that was generated in Friday's session was when oil crossed below 75. So we kind of get an idea. If we see a lot of blue or green here, that's positive. If we see a lot of red, that tends to be more negative. So it can just kind of help us get an idea what's happening in different parts of the market. Then we look at the technical scores of 5 main indexes. Of course, everything that I analyze and all the strategies that I do and teach, they're based on the S&P 500. But we also look at other indexes. We look at the Dow, we look at the NASDAQ 100, we look at the mid caps, and we look at the small caps. And stockcharts.com has this ability to rate it on a technical basis. It gives it a score with 0 being the lowest and 100 being the highest. And we're actually seeing a little bit of a change here. Coming in first place, again, are the QQQs, which is the NASDAQ 100. And if you look at the historical values, this has actually dropped a little bit. We saw this past week, we're seeing the broad market experience more of a recovery and be a little bit more positive, where the QQQs, that's where a lot of the mega caps are. And that actually later in the week started to actually go down and underperform a little bit. They still had a good week, but especially in Friday's session, they didn't perform as well. We had been up into the mid 90s with the QQQs. Now we're dropping down to 89. Then we do have a new number 2 right now. The Dow was up really strong in Friday's session. And this is the Diamonds, which is the ETF that is attached to the Dow. And it had been in a consistent 3rd place for a while. Well, for right now, it's coming in 2nd place at 88.2. Then in 3rd place, which had been in 2nd place, is the SPY. This is the ETF for the S&P 500. We had been more up into the 80s. You can see where it's dropped off just a little bit here. These are all still looking okay, but we just like to get a comparison, especially when we look at the next one. You see the mid caps, they were really showing some weakness. We were well under 30 here not too long ago. Now they're showing a lot of strength, and they're coming in at 67. And the small caps is represented by the IWM. That's the Russell 2000 ETF. We got down into the teens not very long ago. Now we're showing some real improvement here at 52.8. And there are studies out there. There's research to suggest that the January effect, that is really more advantageous to small caps. Now, is that going to happen this year? We don't know. But historically, from about the middle part of December going off into the new year, a lot of times small caps will be in favor during that time. Then we look at some short-term charts. The first chart is a short-term rainbow, and I change all the colors so it looks cool. And this goes from 10 periods up to 50 periods. And I look at this chart in total. I don't just focus way over on the right-hand side. I look at all of this together to get a more of a big picture look at the short term to see, okay, yeah, we're showing a lot of improvement here. We ran into some difficulties in August, September, and October. Now we're starting to come back. So this chart is showing some improvement. We also have some different moving average studies, and there are different ways to calculate moving averages. This one takes a double and triple exponential moving average based on 20 periods, and it comes up with a green line and a blue line. And when the green line's above the blue line, that tends to be faster because the double moves quicker than the triple. And so, and price is still moving along, and this is showing a lot of improvement in the short term. Then we compare that with a regular moving average, a simple moving average, which takes all 20 periods and treats them the same, versus an exponential moving average, which is more weighted to more current prices. And the debate goes back and forth, which one is better. A number of years ago, John Murphy, who's kind of the grandfather of technical analysis, he wrote the technical analysis book, and he did a lot of research about this, and he did some testing. His results were that simple moving averages tend to be better than exponential moving averages because they move a little bit slower. And if something moves faster, people have a tendency to jump the gun and they end up being wrong. Where if they just waited a little bit longer, they ended up doing better over the long term. But you can also make an argument against that as well. What we're seeing is price is well above both of the moving averages here. The blue line is still above the red line, but it's slowing down a little bit. That means the exponential is moving faster than the simple moving average. And when we're really moving up, that's what we tend to see. The fact that we've been chopping sideways lately, that's why this is slowing down and potentially even crossing over. We're going to watch this. If this crosses back over the red line, the blue line here, that could be kind of an early warning sign that we just want to be aware of. Then we look at some intermediate term charts. I have another rainbow from 50 periods up to 100 periods. I take all of this together and we're well above all of the lines in the moving average, and they're starting to turn back up. So this is looking more positive. Then we look at Bollinger Bands, which are very popular. There's a number of different ways that you can use Bollinger Bands. I use them in a lot of different ways. Are we above or below the midpoint? That's one way. But we also have the percent B indicator, because there's a very small fraction of the time where we end up closing either above or below one of the Bollinger Bands, either the upper band or the lower band. And that's what this indicator measures. We were really moving up and we actually hit that, but we don't stay there for very long. So we backed off of that. Now, another way we can use this chart is we're above the midpoint and going up. So that gives us more of a positive bias. Then we look at an anchored moving average going all the way back to the all-time high. We had been coming down when we were really falling, and we dropped below this, but then we've been able to get back above it, and we're going back to this previous high now. And since we're far away from this anchored moving average, I haven't been showing this chart. Then we look at the Connors RSI, which is a lot like a regular RSI. We look for extreme positive or negative readings. We can also get a bias from this. Are we above or below the midpoint? Well, we're above and not getting an extreme reading. We were, and I was showing this chart for a while, but lately I have not been showing it. Then we have the same basic concept based on 50 periods with a double and triple exponential moving average. When the red line is above the blue line, that means we're going up pretty strong. And that just promotes the idea that we're looking fairly positive right now. And price is above both of the moving averages, and that's also positive. We compare that to a regular 50-period moving average study, where we do see that the blue line is above the red line. Both of them are going up, and we're kind of far away from these lines, so I haven't been showing them. The same thing is true with the 100-period moving average study. We were stuck in between the simple and exponential moving averages there for quite a while, but we were able to break out above that. The green line is above the red line. That tends to be more positive. It would be even more positive as well if the red line was able to get back above the green line. The red line here is the exponential moving average, which tends to move quicker. Then I was showing this, my goodness, for almost the whole month of November. We were looking extreme positive with the CMB composite index. When we get above this black line, well, we finally drop down below it, and we are going back up, but we're not getting an extreme reading right now. Then we just want to see, are we above or below the 200-day simple moving average? When it's green and going up, that is more positive longer term. Standard deviation. This doesn't necessarily measure direction. This measures speed. And as we've been chopping sideways, we can see where the standard deviation based on 10 periods is really dropping down to a low level. The Pring bottom fisher, I had been showing this, but now we crossed below the black line, crossed below the red line. So the signal is no longer valid here. That's why I stopped showing this one. We want to keep an eye on the S&P 100, which are the biggest stocks in the S&P 500. And actually, we're seeing kind of a positive negative divergence, if that even makes sense. If you look right here, you can see where we're breaking out a little bit with the S&P 500. That's broader range, where we're not really seeing a breakout right now with the S&P 100, because we're seeing more stocks participating in the upward move. If we were seeing the S&P 100 breaking out and that's not being confirmed by the S&P 500, that would be more of a warning sign. We'll have to see if this continues to look the way it has been. Then these are just some measurements, and I do this myself. I draw all the lines, and if I move them just the teeny tiniest little bit, it changes all the calculations. This just gives us an idea. We have the all-time high over here on the left, then the October 2022 low, and then the measurement up to the high that we set on July 31st, then the retracement where we hit the bottom, and now how we're coming back up and possibly retesting that previous high. This is a 50-day cycle, and there are all kinds of cycles, and you have folks that are just totally convinced that their 23.496 day cycle is the absolute bomb. Well, I'm not that convinced. And so I look at a number of different cycles. A cycle that seems to be kind of helpful over the last year or so has been the 50-day cycle. And we had the last cycle that started on October 17th. The next cycle will actually be January 1st, but the market's closed, so it'll be the first trading day in January. We did not have anything new drawn on the point and figure chart. When we're going up, there are X's. When we're going down, there are O's. This doesn't take time into account. 1 hour can be as powerful as a year as far as the point and figure chart is concerned. However much it takes to draw in a new X, it doesn't matter how long that takes. It's just, does it end up happening? But right now, we're not seeing any new X's or O's drawn on this chart. The last signal was generated on November 20th, and that is a double top breakout. The mass index is not generating a signal right now. We really only get excited about this when we get up to the red dashed line and the blue line. Some long-term charts, here's another rainbow going from 50 periods to 250 periods. We're above all of the lines that make up the rainbow, and they're starting to kind of flatten out a little bit and turn up slightly, so that is positive. Then we have a longer-term moving average study. Just on top, I have a 50-period moving average study for reference. Then we have a 150 and 200. When we're above the 250 line here and going up, that's positive, and they're both going up. Now we want to keep an eye on this. If we continue to go higher, we might get to an extreme positive reading, but we're not there yet. The daily special K chart, I mentioned this in every video, but we don't get very many signals from this, so I just mention it. But here I show it actually in the video where we crossed back over positive. Now we're still negative with the weekly chart, and that's going to take a while for that to show some improvement. But the fact that we were going negative with the daily chart and now we're turning back positive, that is a good sign if you're more bullish on the market, because we don't get an awful lot of signals from this indicator. Then we look at a weekly chart of the S&P on top, the German DAX weekly in the middle, and then we look at the correlation, and they're having a pretty strong tendency to go in the same direction at the same time. Then we look at the U.S. 10-year yield, and we subtract the German 10-year yield, and that gives us a line. And when it's positive, that means that the U.S. yield is higher than the German yield. And what's really interesting about this is we can plot the U.S. dollar index, and there's actually a pretty strong correlation between the two. So when this is going down, that tends to be more positive for stocks. When this is really going up, that's when stocks tended to be more under pressure, both with the dollar going up and with this result that we get in the top. Support and resistance, haven't been able to show a lot of these charts. This is a chart that I came up with, I think it was influenced by a video that I watched, where I drew a trend line from the June 2022 low to the October 2022 low, and then I went to the all-time high and drew a parallel line down here. And when we were screaming up over here earlier in 2023, this did act as resistance a few times, but then we were able to break through it. We've been above it since then, so I haven't been showing this chart. When we were really coming down and having some problems, I was bringing this chart out because I thought maybe we'll get down to this point, but we didn't. We ended up turning and going back up. Now we're far away from that line, so I haven't been showing this chart. Then I just took the low that was set during the COVID plunge and the all-time high, and you just break these up into 25% chunks, because sometimes this can act as either resistance or support. Well, we're right in between this 100% from 75% to 100%. And we're kind of in no man's land right now. So there's been no need to show this chart. We're kind of seeing that same thing with a shorter term fib chart. We measured from a high down to a low, where we've retraced all of that and then some. So I haven't been showing this chart. This is a longer term fib chart where we are kind of in no man's land. We're above the 61.8% retracement level. We have not got all the way back up to the 100% level. And here's a longer term fib chart also. We continue to be in no man's land. And this is an indicator I developed decades ago. It's very simple. It's just a 20-period simple moving average of the open, high, low, close. We're well above all of the different moving averages here, and we're moving up higher. And this produces like a mini rainbow. So this is tending to be positive right now. We have an Ichimoku cloud. I was showing this chart as we were having trouble breaking through the red cloud. Now that we're above the red cloud and we see the cloud starting to turn green, that's more positive. As long as we stay above this, I won't have a need to show this chart. Here's the NASDAQ 100 with the Fibonacci retracement levels, and we continue to be in no man's land. Then the financial sector, we have a support level down here, but the financial sector has actually been seeing some strength lately. We're well above the support level, so I haven't shown this chart. Some broad market measures, we have the VIXN, which is attached to the NASDAQ 100. It's like the VIX for the S&P 500. And I mainly look at the the line chart down here, and it just shows that there's not a lot of fear right now. And then we have a weekly chart of the QQQs, and then an anchored moving average going back to the all-time high. Even when we were declining, we were still far above this moving average, and we're actually breaking out above these previous highs. That could be pretty positive. The bank ETF, which took a dump in March, went sideways, and now it's finally breaking out above the 200-day moving average. If this continues for a while, we might actually see a golden cross here. But for right now, we're still in a longer-term downtrend. When we look at the regional banking ETF and then take a ratio with the financial sector, yeah, it's showing some improvement. And we're going to need to see this really go up for it to turn positive. But for right now, it continues to be negative. Then we look at a ratio between the QQQs and the diamonds. That's the NASDAQ 100 and the Dow. And we're seeing that they're really having a tendency to go in opposite directions. This really shot down on Friday. The Dow was up big, and the Qs were actually, or the NASDAQ 100, I think it was down a little bit, or if it was up, it wasn't up very much. And so we're seeing them having a tendency to go in the opposite direction. That's more of an anomaly. If you see other times when we came down like this, it doesn't last for very long, where they have more of a tendency to go in the same direction at the same time. Then we look at TIPS, which are Treasury inflation protected securities, and we compare them with, okay, is it better to get a shorter term TIP, which I can get more favorable interest rates because they're shorter term, and then I'll just roll them into a higher interest rate. Well, when interest rates are going up, that's what you want to do. When interest rates have topped out and maybe that's the highest they're going to be for a while, then you stop that strategy and you jump over and you get into 3 to 7 year bonds. And that's what we've been seeing. We've been seeing this ratio going down. When interest rates were going up, TIPS were outperforming. Now they're underperforming because folks are favoring bonds over the shorter term inflation protected securities. And here's another look, looking even further out. We look at the TIPS, where this first chart, that's 3 to 7 years. This next chart is 7 to 10 years. And we had been seeing kind of something strange here, where TIPS were actually outperforming longer term bonds. But lately, this has really been coming down, meaning that the 7 to 10 year bond is more favorable or more appetizing than the Treasury inflation protected securities. Then we look at home construction, which is very, very sensitive to interest rates. If the market was concerned that interest rates were going to go up, we would not see this ratio going up the way it is. When we were running into some problems and interest rates were going up, we saw how this ratio was going down. Now we have been going back up. And I have a lot of charts that kind of mirror that same thing that I'll show later on. This is a rate of change chart looking at Friday's close and then going back 250 periods, where we're pretty much chopping sideways now. Here's that same chart going back to 1980, not really showing anything all that decisive. Bonds, we look at the 3 to 7 year bonds and compare it with the S&P 500. When this is going down the way it has been, that means bonds are underperforming the S&P 500. Then we look at the long-term bond ETF. That's the 30-year bond. That's in blue. And then in red, we have the S&P 500. And we can see that over 50 periods, they have a pretty strong correlated relationship. Based on a shorter term time frame of 10 periods, their relationship is still pretty strong, but not as strong as it has been. And then on the bottom are just a couple of different ways to measure the spread between the two. We look at a ratio between the QQQs and the long-term bond ETF, and they're having a pretty strong tendency to go in the same direction. So if the long-term bond is up, then the Qs are probably up as well. If they're going down, they're probably going down together at the same time. Then we look at the yield curve. The two most important parts of the different yield curves are the 10 to the 2-year. That's still inverted. The 10 to the 3-month is also still inverted. The 30 to the 5 and the 10 to the 5, they're back to being more normal, but they could easily slip back and be inverted at any time. Then we look at the S&P 1500, which is a broad market measure of stocks, and we compare it with the 1 to 3-year treasuries. And this just shows that even the broad market is outperforming shorter term bonds. Then we look at the tech sector and we compare it with little further out bonds, showing how the tech sector is outperforming. And then we look at the 1-month T-bill, which is pretty much cash. We compare it with further out bonds, where now this is starting to come down. When this goes up, that means there's uncertainty about interest rates. The market's getting more confident that maybe, just maybe, the Fed is done. But we got suckered into that last spring where this ratio really started coming down. And then it's like, no, the parade is over. It's starting to rain. And then this started to go back up. Now it's starting to go back down as the market's more confident that maybe this time the Fed is actually getting close to being done raising rates. Then we look at the 1 to 3-year treasury bond, that's shorter term. And then we look at a further out 3 to 7-year bond, and we take a ratio. And we got suckered in here. This was really starting to come down, and I'm like, okay, maybe they're done raising rates because folks are favoring further out bonds than shorter term bonds. And then back in June, this really started to go up again. It caught the market off guard. But now we can see that this is starting to come down again as the market is more confident that maybe the Fed is done raising rates. Then we look at junk bonds, which really mirror the stock market. These are high yield bonds. And we compare them with the 3 to 7-year bond. Which one is better, or which one's been performing better? We look at a ratio here where we were getting mixed up, and then in spring started to kind of gyrate all over, but now it has resumed going up. And think about it. If you have a chunk of money, would you rather get 8.44%, which is what we had as of November 30th, if you get into a junk bond, or 4.38%, less than half of that, getting in a government bond? Well, it doesn't take much to say, okay, I'm willing to get double the yield, even though I know I'm assuming more risk. But when you look at junk bonds, they're doing okay because the stock market's doing okay. So a lot of folks realize the risk is worth it for right now. Then we also look at another very similar type of study where we're seeing a lot more confidence right now. And I didn't change this. I meant to change the yield to maturity date here. But basically, when this is going up, that's when folks are more risk on. When this is going down, that means folks are more risk off. This has been going back up, so folks are getting more confidence in the economy looking ahead from here. Then we look at this is an inverse of that same study that we just showed. The 7 to 10-year treasury bond versus the 3 to 7-year bond. This is starting to go back up now, meaning that the 7 to 10 years is starting to outperform. The longer term bond is outperforming the shorter term bonds. And then this is one where we want to kind of get an idea, what's the stock market expecting? We're looking more in the soft landing category. When you take the S&P and compare it to 3 to 7-year bonds, when this is going up, that's more the soft landing approach. When this was coming down, that's more of a hard landing, meaning that we're going to head into a recession. The market is really anticipating the idea that we have seen economic weakness, but we're not necessarily going to go into a recession. Then I have some possible positive scenarios. A lot of times these are designed when we're really going down and we can try to find a bottom at some point, but these are also useful even when we're going up. This is the percent of stocks in the S&P 500 that are above their 200-day simple moving average, and we're above 50 and advancing, so that's showing improvement. Then we look at a 50-period moving average study, and that is also up for the S&P, also improving for the mid caps as well as the small caps. So thank you. This is probably longer than usual. I usually try to keep this video kind of short. Please feel free to check out the other videos that I post. I hope you're having a really nice weekend, and I will talk to you in the next video.